Hmm?
All right, test. Somebody give me a little feedback if you don't mind.
What's up, Jason?
Hey, how's it going?
Good. How are you?
This is exactly what's keeping the country divided. The man ain't Trump.
All right, so here's the deal. We hear some political commentary in the background. It's good to have folks coming in. I'm admitting people here. I do want to say a few things. I'm going to try to get to everybody. I ask,
White in
I
the
ask
front.
that you stay muted
Huh.
when you come on. I ask that you stay muted, not because I'm trying to censor you. I'm going to try to get to everybody, but just because there's feedback and it screws with the quality of the live stream if we don't mute ourselves. I'm just going to try to go through this one by one. If you have any questions, have them ready. We have 27 people in the room right now, and it's continuing to fill up. So you have a bit of a busy group here, but let's rock and roll. And we're just going to go down the line. So when I call your name, if you have something you'd like to say, jump in and let's rock and roll. Okay, so we are recorded, by the way, and this probably will show up on YouTube. So just operate with that as you see fit. All right, we're going to start with Amarjit. Amarjit, you've got the big beard. How's it going, partner? How can I help you, man? What are you thinking? Anything you want to comment today on the stream as far as buying businesses?
Very good, very good. Well, the main reason is how do you start? I heard of that opinions you need a dream team, but I heard of others you don't need one.
Everyone else that's popping in, I need everyone to mute yourself if you're not talking. It's not about censoring you. It's just about keeping the quality of the stream up. All right, everyone. I'll try to get to everybody. Look, to answer your question simply, if you're going to go out and buy businesses, do you think it makes sense to have a team around you that knows what they're doing if you lack some of the experience? And Amarjit, I'm asking you, like, do you think just rationally makes sense to have some experience around you?
Yes.
I mean, that really answers your question simply. You really need to have the core components of the deal-making process around you as far as expertise if you're going to be successful in this game. Failure to do so can lead to calamitous results. So really, the nuts and bolts is the industry that you're going to be operating in. We have to know a hell of a lot about that. Usually, it's good to bring on an advisor or somebody that can advise you about your industry. Accounting support, we're going to be going through tax returns, balance sheets, P&Ls, looking at aged receivables, aged payables. These are fairly complicated items. We're also going to be looking into the nitty-gritty of tax returns to confirm earnings. Really important stuff. So you're going to want an accountant around you. And then you're really going to need an M&A attorney to help you with the contract work and throughout all the steps of basically buying a business. Now, you can build that dream team. You quoted Pena. We can build the dream team by compensating with equity, right? So we don't need to pay cash for these individuals. We can give them, 2 to 3% of what we're doing respectively. Do I think you need a team of 10 people like others perhaps Pena have talked about? No, I don't believe that's the case. And I've seen that firsthand with my clients and with myself. You don't need to have 10 people on a team. An accountant, a lawyer, an industry expert, and you really have what you need to be successful in that realm. So that's really what I would recommend for you. All right, Amarjit?
Thank you.
Cheers. All right, one sec. We have a lot of people joining. This is a recorded call, so just be mindful of what you say. It might get posted on YouTube. Normally, we used to do this live stream on YouTube. We're having a lot of people coming on. It's great to see you all. Matt, I see you're next. You're wearing kind of a blue polo. Matt, if you have any comments or questions, it's your moment at the microphone. How's it going, sir?
How you doing? So the biggest thing for me is, I have some capital available. I currently have one business right now. I'm trying to leave my other full-time job and acquire another business. And I've been on the search and on the hunt for a long time. And just finding quality businesses for sale is the biggest hurdle for me.
Okay, I don't see where you're coming from, but oh, there you are, Matt. Good deal. So let me ask you, what industry are you looking for deals in?
I currently have a pool business, but I'm looking for, HVAC, electrical, plumbing, something along those lines.
Okay. I can tell you, being that I'm in the plumbing and HVAC space, if you're going on the home services side, it's really competitive. The home services side, so like servicing Mrs. Jones, fixing Mrs. Jones's water heater, fixing Bob Smith's air conditioning unit, that is being dominated by private equity. You are going to struggle if you're looking for meaningfully sized companies in home services. If you're competing in major tier 1 markets, usually Matt, and this goes for everybody here, you have to understand what you're up against. And bluntly, if you're going in home services in the trades, you're competing with some serious firepower. So what I really recommend for somebody that wants to get into the trades is you have to bend in some regard. You either have to look into tier 2 or tier 3 metros, right? So in other words, instead of going to Atlanta, you're looking in Macon, Georgia. So that's, if you want to stay in home services, then looking in tier 2 and tier 3 metros is a place to play. That's one option. Another option is you look for deals that are doing 1 to 2 million in sales, as opposed to 2 to 5 million in sales. Everybody likes the 2 to 5 million in sales more. It has a little bit more meat on the bone, usually has a bit more management in place. But again, you're going to be dealing with that more stiff competition. Or you explore those kinds of deals, but look more in a commercial setting where you're not getting paid same day, next day for services. And the business is less dependent on the Google brand and more dependent on relationships with developers, with contractors, with things of that nature. If you have some flexibility in 1 or 2 of those areas, you'll find more deal flow. The other elephant in the room is, I don't know you, Matt, but I'm going to assume for a minute your positioning is good and you're communicating like a professional to brokers, and you're reaching, you have some form of outreach campaign to get off-market deal flow. Positioning is really important in the game of deal flow. Most people are screwing up the game of positioning. Their LinkedIn doesn't speak well about what they're doing. They themselves aren't communicating like a professional about the deal-making process. How you communicate with brokers and with sellers is going to have a huge impact on whether or not you're going to get a pocket listing. A pocket listing is what we live for in this game. Pocket listing is, hey, you know what? A company right here is for sale. I know they're for sale. Not everybody's seeing this, but because you look like a qualified buyer that's going to do right by this seller, here, have a look. So that's really the last piece I would say, is think about your positioning. But those would be a couple of items. It's just be mindful of who you're competing against. And, if you're competing in a tier 1 market for HVAC business, if you're looking in Atlanta for a $5 to $10 million HVAC home service company, you're literally competing with private equity groups that may have 50 or $500 million in liquidity just sitting in a checking account. So it's like, you have to be mindful of where you're at. So that's something to really be thoughtful of. All right.
What about home health, nursing homes, like medical?
Some of the same dynamics are there. Look, for a lot of the businesses that everybody wants, you're going to have to usually concede on one of the primary points. When you talk about deal flow, like everyone wants what everyone wants, right? Like generally speaking, almost all people searching for deals want the same thing. Tier 1 market, management in place, exactly 3 times earnings or less, and perfectly clean tax returns. We all want these things. Usually, if you as a buyer can find 1 or 2 things that you're willing to be more flexible on, you'll give yourself a competitive advantage. I had to learn this really early when I started in the mobile home park business. Most of you don't know that business, but everybody wants a tenant-owned home lot. They all want to be in a tier 1 metro. They all want to be, with 1 million people and 5 miles of them. They all want the paved road. Everyone wants this perfect institutional asset. And it's like, okay, if you're going after institutional assets, then great. Expect to compete with institutions. Oh, by the way, institutions have, one institution has deeper pockets than all 55 of the people on this stream combined. And that's no great, including myself, that's no shade on any one person here. It's just to speak to the power of an institution. So you have to be a little bit more strategic in sourcing deals and find where you're going to be flexible if you want to actually get your foot in the door and then go from there. Once you get your first deal done, then it's a little easier to have higher standards, because now you can more effectively do outreach campaigns to sellers. They'll be more receptive to you once you're already in the game. Now you're not just a cheap suit with a silver tongue. Now you're actually an operator in their business. And then you can start basically really making the pitch of, yeah, sure, you could flirt around with a private equity group, but here's why it's better to partner with us instead. And once you're an operator in the game, then you can start really having a persuasive conversation with the seller as to why it's a better fit to go with you, even if you can't pay him quite as much. And you can be more effective in that realm. But going from 0 to 1, usually if you can concede in some regard, maybe it's more commercial work if you're talking about a service company, it's a little bit smaller, or it's in a tier 2 or a tier 3 metro. If you can give up on one of those points, not all of them, but on one of them, you'll increase your likelihood of getting in the game tremendously. Does that make sense? I'll take a lack of answer as a yes. If we have other questions and other people. All right, I digress. Darius, how's it going, partner?
Hey, what's going on, Jason?
How's it going, sir? How can I help you, man?
Man, really, man, what's been getting in my way is the just presenting, presenting seller finance, man, just getting that extra to push everything forward.
Second position seller finance or front end seller finance?
Front end. I mean, second position.
Okay, so just for everybody on the stream, I'm going to do a screen share here real quick. We're going to see if this works. If you have can you guys see my screen?
Yeah.
Yep. If you have $1 million, if you have a $1 million, you know, usually this first 80% or so is going to be SBA debt, right? This will get you about 80% of the way. This last 200,000.
Check the salmon. I don't even know if it's done.
I need you all to mute yourself if we're going to do this in a way that's proactive here, just because we can't have one person talking to the dog messing up the stream for 50 people. Thank you. So we've got this last 200K. This is where the magic happens. This is what we're referencing when we talk about back-end seller finance. Maybe 50 of this is going to be cash. 5% SBA requirement might be cash for 50K, right? And then this last bit here might be, you know, the seller finance, the 150K of seller finance to get paid out over 5 years at a 7% interest rate or something like that. So, right, Darius, we're talking about this here. This is the part you're having a hard time getting sold. Is that correct?
Yeah.
Okay. So what's specifically happening? They're saying, screw you, I need all cash. Is that?
Yeah, it's pretty much like, why do you need my help to close it out? You guys are supposed to either have it or, you know, just you're trying to cheat me out. Are you trying to get me to lower my price? And it's not that. It's just
right. For the record, back-end seller finance is very common, even with larger, you know, private equity size deals that get in the 8-figure plus realm. Very rarely is every dollar in the purchase price paid out in cash at closing. It's like very common, you know, in the bigger world, it's called an earn-out, where the performance of the business post-close is going to influence, you know, whether or not the seller gets, you know, this amount versus that amount, right? There's going to be this kind of sliding scale of things. So yeah, somebody writes in the chat, and I actually totally agree with them. A seller not being willing to hold even 10% of the note is generally a red flag. I agree with that comment. And would further say that there's a little bit of an education process that needs to happen from somebody. Now, Darius, I didn't ask you this, but I mean, you know this part of it. You know, is this an on-market deal listed by a broker, or is this, you know, an off-market deal? And I imagine you're probably flirting, you know, in both sides of the continuum. To that end, somebody has to provide some level of expectation to the seller. That, by the way, usually for, you know, smaller business acquisitions in the $1 to $5 million deal range, you can expect approximately 60 to 80% of the purchase price, you know, at closing up front, and then the balance is going to be paid out over a period of time. But as far as like getting that over the hump, you know, I see some familiar faces here, and some of you know this is kind of a crying call that I always make is you can't make sellers get motivated, but you can find more motivated sellers. I'll repeat that. You can't make people get motivated. You can try to persuade them and sell them on the good life, and you're going to go fishing more, and by golly, it's going to be a great time, and you're going to play with the grand. Like, sure, you can try to warm that up, to lubricate that a little bit. But at the end of the day, either somebody is motivated or they're not. And it's much more interesting, in my opinion, to focus on finding more motivated sellers than it is to try to get somebody to have the requisite motivation needed to do a transaction. That would be what I would say, Darius, in a nutshell, is keep on knocking on doors. And this is, you know, really the essence of what's going to allow you to get that back-end seller finance that you need. I don't think he's on the call, but I have a client right now that's working really hard that, like, if they can just get the seller to increase their seller finance amount from about 12% up to about 20%, the deal will close. Often it's that difference between the seller being willing to go 10 or 15% versus 20% for a first-time business buyer that quite literally makes the difference between the deal happening and not. And if you get close enough with the seller, and then it's quite literally a conversation of, hey, look, if you increase the amount of paper you're holding in seller finance, right? So if you increase the amount of seller finance on this deal from you having 10% of the purchase price in seller finance up to you having 18%, then we can close this deal in 2 weeks. So a lot of it too, you know, Darius, you may recall this from our conversations in the past, is this concept of getting the deal pregnant. Like if you can get the deal so that it's close, so that, you know, we're on the goal line, to use a football, an American football metaphor, like, you know, it's first and goal. We're in the red zone. You know, hey, lender's willing to come this far. I'm willing to put this much in cash. You right now are willing to do, you know, 150,000 in seller finance, Mr. Seller. Mr. Seller, if we can just bump that up to 225, you're going to have this deal closed and the keys are going to be transferred over in a matter of 2 weeks. Ball's in your court. Do you want to put this thing to bed? You know, if you're dealing with a motivated seller, you know, that's going to be a conversation that goes in your favor. And I can say that from firsthand experience.
We were going back and forth with brokers, and of course the brokers like, oh yeah, they're motivated, they're ready, but of course they don't have to sell, you know. But I'm like, all right, so we got an investor, we got an investor, and the investor was, like you said, they weren't trying to come in with seller finance. Then they looked at the deal as iffy, and they were like, hey, well, if they're not going to invest in their own deal, you know, we could have lost that money. So just try not to walk away from the table too soon, I guess. But like you said, find somebody who's motivated, and we can roll.
Yeah, look, not to bring politics into it, but you know, the old Donald Trump takeaway clause sometimes is exactly what the doc ordered when it comes to deal making. You know,
Yeah.
Sometimes you just have to be willing to step away from the table and say, hey, look, it sounds like this isn't a meeting of the minds. And, you know, therefore we're going to proceed on to you know, opportunities that really make more sense for us. By the way, I'm trying to think, I've had multiple instances personally whereby we flirted around with the seller. There was not a meeting of the minds. We took our ball, we went home, only to, in subsequent months, have a new conversation. And that new conversation several months down the road led to a transaction. Sometimes you just have to walk away. And to use a dating metaphor, I mean, if it's a guy or a girl you're dating, either one, we have mostly guys here, but a couple of gals here. Sometimes she has to realize what life's like without you before she can really realize, you know, what the next step looks like or why it might be worth taking that next step. Right? Yeah. Sometimes your worth is much more apparent when you leave the room. So that's which isn't fun, right? It takes discipline, and yet this is why an effective deal flow campaign is the most important part of this process. Which is why I like that. That's the majority of the conversation we're having so far. Is how do I get the deal flow? There's so far these are good questions because we're not talking about where does the money come from. The first 80% of any deal comes from the SBA. If you buy into what I'm preaching, I mean that's not the complicated part here. The money solves itself. The deal is structured accordingly. And there's 100 YouTube videos I made for free talking about how to do that. That's not the existential part. The existential part is not messing around with unmotivated sellers. And, you know, in other words, we need motivation from the sell side and then enough deal flow to be able to play that hand with a level of conviction that gets deals done. So you know what it is, Darius. You know this game. It's just more of the same. All right, man?
That's it.
Make it happen, Captain. I'll talk to you soon. We've got a couple of you that are, we've got Blake Davis, and then we've got, I'm going to basically just go to people that raised their hand. It looks like our chat's starting to get engaged. And I see Blake Davis, you did this little hand raise thing. I don't know how you did that, but that was slick. So let her rip. And if you guys want, we're just going to go to the chat as opposed to me trying to talk to all of you because we've got enough here where the odds of me talking to everybody is slim. But I can hit the chat and we're going to rapid fire these as well. So if you just have a simple question that I can start reading through in the chat, roll. And then Blake Davis, let's rock and roll. And now we have a bunch of hands. All right, well, you guys want to raise hands? You got to put it in the chat. I'll go back and forth. Blake, let's rock and roll. How you doing, partner?
Hey, Jason, how's it going? I'm under contract on a plumbing company currently. And it's a small business. They've got 3 techs. I've, never done any kind of plumbing work. So I know you're in the plumbing space. Do you have any advice on, getting in there and stabilizing it and scaling it? It's an owner operator and he's moving out of state. So there's no management in place. It's just the 3 techs.
Yeah. Oh boy. And I don't say, oh boy, like it's all screwed, but Yeah, I have a lot more to say to you than I'll be able to on this Zoom call. But look, here's what I can say in short. Okay. First of all, let me ask you, are they doing commercial work or service work?
Service.
Okay. Good. How does their brand look? Their Google presence,
They
yeah.
basically non-existent. They've basically grown by word of mouth. So they were a franchise, and then he disconnected from that franchise, and he had a non-compete. So he just kind of flew under the radar for a couple of years while the non-compete went away. And now that that's gone, now he's selling it. So now there's opportunity to market it and grow the business.
Okay. So I don't mean to get up in your business, except here I am getting up in your business. So what the hell am I even saying? Hopefully you're not paying too much. I don't need to know the exact details of it, but an owner operator 3-man service outfit with no online presence. If you're paying too much, it's time to beat them up.
Okay.
I mean, that's the first thing, because I can tell you a couple things about service techs. They're fickle. And unless if you have about 5 service techs, 5 is that number when you buy this business. I mean, okay, so a bunch. I can't give you everything, but I'll give you a few things off the top. For one, you need to implement a game plan to get up to 5 service trucks ASAP. Once you have 5, you gain a whole new level of leverage. When they only have 3, one guy calls out sick, 33% of your manpower is gone. 2 guys call out sick, your company's upside down for the day, right? So
yeah,
3 mutinies are a real risk factor, and you really have to massage that. So I hope you're not paying much, and I hope you have some skin in the game, some seller finance involved, or you come with fairly deep pockets, because you might hit some turbulence. Service techs are known to try to leverage their bosses in a pretty meaningful way, especially when it's a small service outfit like that. All right. Secondarily, your Google brand, your online presence. You're a marketing company that happens to do plumbing. You're not a plumbing company. You're a marketing company that happens to do plumbing. So that's a huge and extremely important reframe. Look, you can make a ton of money doing this kind of a deal. I'm going to just throw numbers out there. Maybe you're paying $500,000 for this thing. Hopefully you're paying closer to 250, but let's just say you're paying $500,000. Okay. You're paying $500,000. The ease from which you can take that business and take it from a $500,000 business to a $2 million business cannot be underestimated. You add 3 or 4 more trucks into the mix over the next, 24 months, and get 100 Google reviews at a 4.5 or better stars, and start getting that phone to ring organically. Next thing you know, you're doing 1.5 or 2 million in top line. You're doing 300,000 to 400,000 in bottom line. You're selling at a 4 to 5 times multiple, because everybody loves home services. We were just talking about that a minute ago. And you're taking 7 figures out of it before tax, and you're doing it in a 2-year span. So you've got a real play here to do really well for yourself in a fairly short amount of time. But I just want you to know that you're going to go into a bit of a dogfight to stabilize this thing. I imagine that, right? It's an owner-operator play. The owner's moving out of town and whatnot. You don't need to be a world-class plumber, but let's hope at least one of those guys are senior techs. Otherwise, you're going to be limited to doing things like drain calls and leaky faucets and just goofy stuff, where the real money is in doing more complicated, higher barrier to entry work. But I mean, what can I say? Just don't overpay for the thing, have enough working capital, build a game plan to build a great online presence. You're a young guy, so almost everyone here is on the south side of or on the front 9 of their life. Most of these guys selling these businesses are on the back 9 of their life. So just knowing how to use Google, and knowing how to use a Gmail page, even just knowing how to log onto a Zoom call and have an image of your face there, quite literally, is stuff that most of these older kind of blue collar guys don't understand. So just a little bit of that internet savvy will go a long way. Build out that brand, add a few more trucks, and you can make 7 figures in a pretty short amount of time. But it's going to be a bit of a dogfight. You're going to have to get in the grid of it a little bit. And then lastly, get good at recruiting. My hot tip: Indeed. Use Indeed. Pay the $5 a day to have your ad go above 80% of the people that are unwilling to pay the $5 a day. You're a recruiter and you're a marketer first.
Okay, awesome. That's very helpful. I appreciate it.
Hell of a lot more I could say, but that's the quick notes. All right, let's rock and roll. We've got Sardor, and then we're going to go to some of the chat. Sardor, how's it going, partner? How can I help you?
Hey, Jason. Yeah, question about those not motivated sellers. What do you think what is your opinion about doing a virtual merger? When you actually convince them to go with you when you are doing a roll up, and they agree on like 3x multiplier now. And then when you do roll them up together, and now everyone's value goes up to like 10, 20x, and now you're actually getting that gain of difference on arbitrage.
I mean, I understand the back end of what you're saying about a roll up for those who don't understand what we're talking about here. And it's the essence of what makes buying businesses a very lucrative sport, which is you buy a number of businesses at 3 times earnings, you put them all under one umbrella, and then the value of each of those businesses from which you acquired individually raises in value when included in a greater consortium or a greater package. So that's sort of what you're talking about from that perspective. Can you explain what you mean by this virtual?
Yeah, virtual merger, because we are doing a home service roll up now, and we are buying out companies like million plus EBITDA, and we are facing a lot of problems like when owner is not motivated to sell, and we are competing with other private equity companies on multiplier. So, and they don't want to sell, and that's where we are convincing them to go to the virtual merger, where they're actually just exchanging the stock in the future, but they continue running their company as it is. But we are making a deal now on a 3x multiplier, but they're getting upside later on when we actually put all of like 50, 100 companies together. Now the multiplier goes up to like 17 to 20x. Now actually they're getting that upside also. And we are we're going to be making like 20, 30% of that upside.
I've got a great book for you. Read chapter 2 of The Making of a Blockbuster. Read chapter 2 of The Making of a Blockbuster. It's a biography on Wayne Hunzinga, who was the founder of both Waste Management and Blockbuster back when Blockbuster had cultural relevance. You're on to the essence of what's required to add enterprise value at a faster rate than you dilute. I mean, the long or the short of it is, yes, you're on to the right. That's the right idea. I've not heard of it phrased in that terminology, but I understand what you're saying. And to be frank with you, this gets pretty complicated, right? Because depending on your legal structure and how you're diluting shares and how you're kind of structuring the back end. I mean, it's a technical conversation, and I'm not going to pretend to be the foremost and preeminent expert on some of those items that really get into the nitty-gritty of contract law and stuff. But if you have an ability to buy businesses and give them a piece of the future upside in the enterprise that you're building as a whole, in exchange for staying on and keeping the wheels on the track, I mean, you are in the middle of building something really valuable, as long as those were good businesses that you bought, and especially if you're able to buy them at 3 times earnings. Read chapter 2 of the aforementioned book. It speaks exactly to that idea in a very brass tacks way. And bluntly, he's built $1 billion business. I've not. So he's got a level of expertise about going from 7 figures to 8 figures. And then, I can talk about, 0 to 1, 7 to 8, and then, that's really where I like to refer to guys who've actually done it. He did it. But that's exactly what you need to read, in my opinion. But you're onto the right stuff. I salute to your efforts and do think that's the right line of thinking.
Thanks, Jason.
Yep. All right, let's do a couple of chat and we'll get back to some of these hand raises here. Juan says, glad to be here. Jason, glad to have you here. Steve's autopilot, I'm an assistant. Okay, that's a different deal. Austin Cox talking about the seller not being able to hold even 10% of the note is generally a red flag. I completely concur with that comment. What is your opinion of a virtual merger? We just spoke to that. You know what? We're just going to talk to people the good old fashioned way. This is I love you all, but if you have questions, do the raise hand thing and let's roll that way. It's just more engaging talking to you guys like for real versus like reading a chat when we have 55 people staring at me. I'd rather talk to real people. All right. So Juan, we're just going to pop to you. Juan, are you there?
Yeah. Hey, Jason, how are you?
Good. How can I help you, partner?
Appreciate it. I have a quick question.
Sure.
Whenever you go into any particular industry that you don't have any prior knowledge to, you mentioned that your dream team has to be a specialist in the industry, a lawyer, and then you said something else, right?
An accountant. Yeah.
An accountant. Well, and do you always hire somebody to substitute your position as the owner to manage basically the logistics and all that, basically be your second man CEO in that business? Or do you take the time upon yourself to get to know the business, have it running, and then hire somebody to substitute your position?
You may not like this answer, and my clients hate me when I do this because I often give answers that aren't black and white, but the answer is both, in my opinion. Yeah, both. And I know both is like that may be like a frustrating answer because it's like, well, I just want an answer, like make it black and white for me. Business is black and white. Business is about 500 shades of gray. The book title was missing about 90% of the actual detail. So what I mean by that, Juan, is yeah, we want to bring on managers to help keep you out of the day-to-day grind so that you can focus on doing more deals, seeing things at a higher level, thinking about the macro, and really building something of meaningful value. And if you're completely unwilling to get your hands dirty at all, then you're going to be able to get taken for the metaphorical ride with a lot greater ease by managers that you hire. Like, in other words, if you take absolutely zero interest in that which you have a vested interest in, you increase your likelihood of, for lack of a better word, getting screwed. So I think both things are true. For me, I'll do a screen share here, my favorite. Let me clear out this one. You can see the screen. I basically have, this is me, JR. And I probably should have had more circles, but we basically have, there's like 6 people. There's the controller, that's basically like a CFO. And then we have GMs that run our respective divisions in the state of Florida. We're operating the state of Florida doing really 4 specialized things. And I have 4 GMs that are kind of like CEOs of their respective division. And then there's me here. Now, so I really don't have to get involved with very much more than just a quick phone call to each person on a daily or weekly basis, depending, to get a flavor of kind of where we're at. If we're building a division rapidly, going through more of a rapid scale up, then I might be talking to this person daily, versus if we're in a bit more of a maintenance mode, I may only be talking to this person, on a weekly basis or a bi-weekly basis, right? So it somewhat depends as far as kind of how intense you are as far as growing that specific part of your business, that division, that arm of your business, as far as how engaged you are. Now, could I have myself completely removed? Yeah, I could. The other part of it is you have to ask yourself, it's all about cost, the cost benefit analysis. Does hiring somebody that makes $250,000 a year, let's just say, to do effectively the roles I do, how much time does that buy me back? And does that prove to be a good use of my time? We're getting to the point where, for me, I should probably be looking to get myself even to a higher level of analysis than where I am now. At the same token, I still, because we're really trying to do a combination of things in our business where we're doing a lot of deals, but we're also growing organically. So I love all the things I learned by keeping just enough of a finger on that pulse so that I continue to improve my craft and feel like I'm building the skill set to be able to scale this business from one state into the Southeast and the Sun Belt, et cetera. So, you have to kind of weigh all these different options and also get a sense of what you like to do and what you're really good at.
Perfect. I mean, I completely understand and agree with you on that aspect, Jason. And my other question, it's a 2-part. Once you start going into acquisition for 7, 8, 9-figure companies, do you think that the process of acquisition is different than the smaller businesses, or it's just a business with a larger scale? And second,
it's different.
Okay.
It's
go ahead.
I mean, just to speak to that real quickly, of course it's different. I mean, it's kind of like asking, I don't know if you like the sport of baseball, but let's just all assume we know what baseball is, right? That's like saying, like, is it different playing men's league baseball, at Sunday at the park versus, playing for the New York Yankees? Hell yeah, it's different.
Yeah.
I mean, when you're doing an SBA deal, you're playing, maybe it's not Sunday league, but you're playing with a bunch of guys that, made it to JV in high school.
Yeah.
That's why we talk about, doing 7-figure deals, because candidly, like, the competition isn't so intense that, newer entrepreneurs can hang. Now we're talking about doing 9-figure deals. We're competing with, Wall Street. We're competing with Mahoney and Son. Like, we're competing with deep institutional players. that
Yeah.
have connections to legislators, that have, connections to congressmen, that have, connections to Ukraine, that have Saudi oil money,
Yeah.
that have deep pockets connected to China. Like of course it's different. I mean, your
Okay.
earnings multiples are fundamentally different. People who act like
Right.
it's all the same, in my opinion, are selling you a bridge that doesn't lead to money. Yeah, it's a different.
Yeah.
But
That's what I mean. That's why I wanted to hear your opinion on it, because I've heard that other perspective where they're like, oh no, it's the same. So that's why I wanted to get your, your reassurance of
it makes it sound
what it
sexy
was
and
like.
sell shit. Excuse my French,
Mhm.
but like, if I'm going to sell you a bridge, I'm going to say, oh yeah, once you learn how to do a 7-figure deal, next thing you know, you just add 2 zeros to it and you're worth $400 million. I mean, buy my program, right? It's like, sure.
Yeah.
If I'm a slimy salesman, I'm saying stuff like that. But if you want my
Okay.
honest to goodness answer, you can build up to 8 figures in net worth by playing in the 7-figure circuit and dominating that arena. But
Yeah.
skills needed to do 8 and 9-figure deals are fundamentally different.
Okay.
Now that's
Cool.
not bad, but it's just that it's a truth. Very
Okay.
quick, 30 seconds, and then we're gonna
Oh
move.
yeah. Yeah, just quick, Jason. When do you suggest having a different holding company for every different industry, or just one holding company that controls all the industries that you're in, or
I
all the
don't
companies?
recommend, I'm gonna question the essence of what you asked. I don't recommend flirting around in a multitude of different industries. I'll leave you with this: a master, a jack of many, a master of none.
Mm,
I mean, even like I reference this book I'm reading right now that is a fantastic book, The Making of a Blockbuster. It's a biography on Wayne Hunziker, who built 2 multi-billion-dollar businesses.
yeah.
He built and dominated in the waste business. And then once that was over, then built Blockbuster. He didn't try to do
Okay.
both at the same time.
Got it.
Another phrase, like I'll use a bunch of colloquialisms, but they're important. He who chases 2 rabbits catches how many?
None.
Right? So yeah, I don't
Yes.
believe in this idea. Business is too competitive to be an average amateur. Right? It's like, we don't come to play, we come to dominate. How do you dominate? By being really good at what you do.
Yeah, you're really good at one thing.
This is competition in the purest form. Capitalism is ruthless. Your competitors want to gobble up your market share and see your profits go to the dirt while theirs rise.
Yeah.
I mean, that's business. So to that end, I want to be exceptionally good at doing my thing. Now, as you scale or grow, I mean, I know for us, we have different divisions and we happen to operate in the plumbing and HVAC trade, but it's all under this umbrella of the skilled trades. We are in the skilled trades business.
Okay.
Right,
Perfect.
skilled trades business, plus we have laundromats, plus we sell laundry detergent, right? So
Got it.
that would be my comment. All right.
Perfect. Thanks, Jason. Appreciate it.
All right, Larry Pruitt, then Paul, then Peyton, then Rochelle Church. Larry Pruitt Jr., how you doing, sir? Larry, you there, partner? Going, gone. All right, Paul, you're up, sir. How's it going, partner?
Hey, what's up, Jason?
How can I help you?
Question for you. So I've been struggling to nail down an industry. I started with education. The deals are just way too small. They don't make any sense. Pivoted to substance abuse and mental health, which is a much healthier industry, but the licensing is kind of tricky, as you can imagine. So I pivoted to assisted living. The margins are even better than they are in substance abuse and mental health. But the problem is, like, the deals are just, there's not as many of them as I imagined. It's not that they don't exist, but it's just like tracking down the owners takes just a ridiculous amount of time because they're never there. It's run by an administrator. How do you even locate them? Their online presence is terrible, as is common knowledge. So it's just tough tracking these people down. I recently moved to Texas, and I've never seen so many 100-degree days in my life. And I was like, man, the HVAC is just a total slam dunk. It's like, it's got to be. So looking into HVAC and plumbing as you're doing. And so I'm kind of wondering thoughts on the assisted living industry just in general, and perhaps on the pivot to the industry that you're in. and best kind of practice tips to kind of get started if I were to go down that path? Because I've seen quite a few businesses for sale in that industry. And one of them, just as an example, is on Business Buy Sell, 750 cash flow, and they wanted 2.2 million. It's under contract already. I just missed it, but it's like, there's got to be a lot of deals in that space. So
let's back up a little bit for a moment. Firstly, I'm shamelessly a huge fan of moats around your business. What is a moat around your business? A moat around your business, this isn't the Webster's definition, but this is how I describe it, and I think we can all agree on this. A moat around your business is a force or a layer of protection that keeps other competition from getting into your business, right? So the skilled trades, there's a moat. The moat is a license. You need a professional license to do plumbing legally in the state of Florida. Same with air conditioning in the state of Florida. It's the same in Texas, by the way, Paul, right? So that's a moat. You were talking for a minute about the substance abuse and mental health business, which unfortunately the state of our country seems to suggest that, you know, we'll continue to have a major need for that.
Yeah.
Again, isn't a great thing as a citizen, but probably a great thing as a business person. Okay. I happen to think that your reason for getting out of exploring that is one that is worth asking yourself secondary questions to. I mean, the idea that it's hard to get into is precisely the kind of problem that I love to solve as a business person. Because once I'm in, now I have a massive moat around me, and guys exactly seated where you're sitting now will say exactly what you're saying on this live stream, which is, man, it's a pain in the ass to get the paperwork. It's a pain in the ass to get the license. I don't know if I want to go in. Do you know what? Screw it. I'm going to look at some other deal. And then there you are, you know, with your hat in hand, you know, there you are kind of winning because you have that insulation. So I don't think I would just throw that to the sidelines. I would explore that a little bit more before punting on that. Assisted living in home health and kind of that whole umbrella. Look, there's some great characteristics to it. Obviously, okay, there's a few things I absolutely love in business. One, businesses that thrive as a result of entropy. Sorry to use big words, but what's entropy? Entropy is basically that all things go to disorder and chaos. The human body goes towards old age and death. That's where healthcare comes in, right? So generally, everyone's going to get old, everyone's going to die. So all of the assisted living, home health, like there's no avoiding it. You're going to need that service. Just like air conditioning in the state of Florida or the state of Texas. There's no avoiding it. Summertime, you're going to need it.
Yeah.
Right? Plumbing. It's been around for 4,000 years, since the days of the Romans. Pipes get old, they break, they crack. People need to flush water, they need water. Okay, we get that. So I love businesses. Unfortunately, the way the world is set up now, the state of the human condition seems to be one of struggle, thus people are going to have mental challenges. You hate to say it, but the mind tends to move towards entropy, just like an air conditioning system goes to entropy, and just like a plumbing system goes to entropy, just like a person's body ages out and needs help. So I think all of those businesses have that core, you know, essence of entropy at their foundation, which I'm always looking for as a business person, right? I don't want to hope for demand. I want to ensure demand is a law of the universe. It must happen. And I'm geeking out about this stuff because it's so important. You're going to take on debt and take all these entrepreneurial risks to build wealth. It's nice to have a foundation where that demand is certain. Plumbing and HVAC. Look, I mean, I've talked about this some. It's a competitive space. Are there a lot of deals? Yes, there are. Is it competitive? Yes, it is. In general, there's competition through and through. So I think for you, explore the mental health piece, see what you think there. Then the home health / assisted living, that whole thing. Of the three, I'm probably the lowest on that of the three. The reason I'm probably slightly lower on that than some of the others is because you have a lot more government intervention with regards to pricing that I'm a huge fan of. A lot of Medicare, Medicaid setting fixed pricing for you when you start playing in that pond. I'm not, maybe it's the libertarian in me, but like when I do a plumbing job, the market tells me how much I get to charge. So that part I love. An air conditioning system, the market tells me how much I get to charge. I like dealing with pure market forces rather than invisible hand type forces. Again, the libertarian in me speaks loudly in that. But I think with any of those, you're in an industry, you're in a business, and I kind of took the long boat to China to answer this question, but I think with any of those, you're in a decent play because the demand is not going anywhere for any of those businesses. And there is some level of a moat with each of them that keeps average Joes from getting in. At the end of the day, it's about looking at who you are, looking at where you are, you're in the state of Texas. And then the thing that most people screw up is they're not decisive enough. I mean, I literally chose to get in the mobile home park business. I realized before I even closed my first deal, I was going to pivot. But you know what? As opposed to pivoting before I closed the deal, I did the damn deal and then I pivoted. And now I've done a number of deals in plumbing and HVAC sense. A lot of people just don't have that grit and commitment once they make a decision to get the damn first down, get the result. So at some point, you got to decide who you are, look at your market, look at what you're willing to do, look at what your skill set is, make a decision, and then get the result. And that's usually where people fail more so than making the perfect choice. I think any of those industries can work for you. So I know that was a long answer, but I wanted to give you some context. Any follow-ups before we move on to Peyton?
Yeah, just you have any recommendations for what a good seller profile would be for a first business? Like I mentioned, that one with 750 cash flow. I have no idea what the employee situation was, what the revenue was. I didn't get any CIMs or anything like that because it was already under contract. But is there like a good avatar more or less to look for that you would say, here's a good price point, here's a good amount of employees, here's how you would approach those employees when you first kind of get off the bat and make sure the ship doesn't tip over as soon as you step on board, kind of thing?
There's a lot there, but I'll try to bite off as much of that as I can. For one, consistent year-over-year tax returns that show similar amounts of sales and similar amounts of income.
Yeah,
that cannot be understated. That's more important than any character. I mean, character obviously matters. Let me not understate that. The character of a sale. If you get gypsy sensations from a seller, that's a red flag. I did one deal in my career where I did not trust the seller, and of course, that was the deal that I basically got scammed.
There's no messed up tax returns with good character.
Yeah,
they're hand in hand.
Well said. And for the record, of course, the tax returns were not super beautiful on that deal. So clean tax returns, no like EBGBs about the seller's character. And then from there, I love, if you can get a business that's doing 2 to 3 million in sales with $500,000 to $750,000 in earnings, and 20 employees, 25 employees, that's a nice, tidy, sweet spot first deal. It's small enough to where you're not going to get too much private equity play and you're not going to get bullied off the ball, but it's big enough such that it's worth your time. And funny enough, it's actually less risky usually signing for that deal than it is, and there was a young man that I respected the hustle. He had the service plumbing company with the 3 trucks. He's going to get a hell of an upside if and when he gets in there and holds down that situation, but he's in for a rodeo.
I'm sorry, what range did you say? Do you want to stay around the range, price range? I missed that. I'm sorry.
Well, about 3 times earnings. Okay, about 3 times earnings. There's a video on my YouTube where I describe what I mean by earnings. It's effectively EBIT. I'm getting a little.
Oh yeah, I'm familiar with EBITDA. Yeah.
Okay, well, I don't believe in the D in EBITDA. EBIT. No D, no depreciation.
I don't believe in the T either.
Yeah, that's a whole other topic. That's why there's hundreds of hours of free content on my YouTube. If you want this stuff in detail, work with me. Otherwise, there's YouTube stuff for days there. And so have fun, bleed your eyes out. But, 3 times earnings, 2 to 3 million in revenue, $500,000 to $750,000 in earnings, 20 to 25 employees. That's the key is the $500,000 to $750,000 in earnings. If you want one KPI or one area to focus on, $500,000 to $750,000 in earnings is the sweet spot, because usually what happens is once the earnings get to 7 figures a year, the private equity, even the smaller, they're all these little boutique shops now, but there's still deeper pockets than any one person ostensibly on this call. There may be a couple of really wealthy ones on the call, but they have more money than most of us, right? And when the private equity group starts messing with your deal, it's kind of like when you're 13 and you're taking a girl out for a date, and then the senior comes and and he starts flexing. You're outmanned, you're outgunned, right? So you're not looking for that dynamic. You want to be in a position where you're not going to get bullied off that deal. Usually, if the earnings are between $500,000 to $750,000, it's small enough so that you're dealing with individuals who are going to be looking to buy that company as opposed to institutions. Does that make sense?
Yeah, no, absolutely. I like the 20 employee thing too. Is really great because much lower reduced risk of mutiny, and it's also the owner's probably much less involved in the day-to-day operations. You just de-risking the thing like crazy. So
yeah, the 3 or 4 person operation, usually it's one click. The
Yeah.
guys. Best case scenario, depending on industry, but best case scenario, they all go out for beers on Friday night.
Yeah.
Worst case scenario, they all support one another's drug addiction.
Right.
I'm not kidding.
Yeah.
Like, for some of the trades and stuff, like, you know, you're not, sometimes that's exactly what it like. So yeah, when there's 20, 25, there may be a bad click within the company. Okay, now you're down to a payroll of 19 versus 23, as opposed to going from a payroll of 4 to a payroll of you, which is a much place to be.
And, you know, if the owner's been doing it for 20, 30 years and he's up to 4 employees, he's obviously a control freak.
Yeah.
So he's definitely pulling all the levers. So
the inability to build systems, right? The inability to scale 1000%. No, your instincts, I think your instincts, Paul, this is you know, I believe the first time we're talking, but I think your instincts are good on this. Decisiveness, you know, you seem to speak well about this process. I will make, you know what they say about assumptions, and yet here I go, knowing I'm walking into a trap. I will make the assumption you're a smart guy. Sometimes smart individuals struggle
overthink this shit out of everything. Yeah.
One thing. Just make sure you have as much bicep as tricep. In other words, for every muscle that goes into the front of the brain, make sure that there's an equal amount of decisiveness if you're serious about the entrepreneurship process.
Nice. Good one. All right. Thanks, Jason.
Cheers. All right. We've got Peyton, we've got Rachel, and we've got and then we got John, and then we got AJ. Peyton, how's it going?
Good. Thank you, sir. My question is like, in the due diligence process, should you look at all the documentation possible that is associated with the business, or stick to specific documentation such as the main ones like P&L, tax returns, balance sheets, or would it be more beneficial to work with an M&A accountant? And exactly like what should your place be in the deal making process?
A lot of questions there, but let's start digging into them. Okay, so due diligence is not a noun, it's a verb. Okay, so it's not like due diligence is just this like static thing. Due diligence is an ongoing process, and as you continue to investigate, you're looking for yellow flags and red flags. And then if and when you smell things that smell fishy, or you find yellow flags or red flags, your job is to dive deeper into that area and to double down, right? So this idea of diligence being like this uniform checklist that always looks a certain way is not how I would characterize the due diligence process. Due diligence is, in my opinion, should be much more dynamic than that, and it should obviously have a general framework for which you're following, but should also have a level of spontaneity associated as you identify things in real time. Stage 1 of due diligence is the very thing you described: tax returns, balance sheets, P&Ls, you know, confirming the you know, the ownership of the company, confirming their licensing and is in order, you know, confirming their insurance, you know, they have insurance, confirming they're operating a legal business, you know, all the core kind of nuts and bolts questions you would ask in that process. And you listed a lot of them there. Like that's almost the phase 1 of the due diligence process. From there, I mean, every business is different. So we have to make sure we offer enough dynamism or fluidity to handle what we're going to find. You know, like let's take a business, for example, consistent revenues, consistent tax returns, consistent financials, but perhaps only has 2 or 3 customers that they do 60% of their work with. Bit of a customer concentration issue. If that's what I'm finding in my phase 1 of due diligence, what do you think a lot of the second part of my due diligence efforts are going to be about? I mean, right? It's going to be about getting deeper into the financial stability in the relationship that the company I'm looking to buy has with these aforementioned 3 companies in this hypothetical, right? Really getting into their balance sheets, their, you know, to the degree if they're a publicly traded company, how are their financials? you know, what industry are they in? Do we think, what geographies are they operating in? How are they managed? Are they on an uptrend or are they on a downtrend? Right. So, you know, as far as the diligence process, you have to look at all the core documents, of course. And like, you know, any M&A attorney can, worth their weight in salt, can get you a due diligence checklist, like a standard due diligence checklist. You know, it's gonna look at the insurance docs, look at the payroll docs, look at the, you know, all the HR docs, look at all the financial docs, you know, make sure that the licensing is in play, look at all, you know, permitting data if they're pulling permit, you know, all of that stuff. But then from there, it's your job just to almost detach yourself a little bit from the perspective of being in the nuts and bolts and ask yourself the big question of, you know, excuse my French, but how does this deal go wrong? Or how does this deal, you know, go down I was going to say a bad word, but I won't. But like, how does this deal get screwed, right? Where does this deal go off the rails? Well, is it the customers that are the question mark? Is it the management team that's the question mark? Is it the industry that's the question mark? Is it the market it's in that's the question mark? Is it in a declining market? Maybe, you know, you wouldn't want to be doing business in Southern California in 2020, in my opinion, right? So it's like, what are the risk factors associated with this deal? And then really asking second layer and third layer questions about that. Now, of course, you're going to want your industry expert to be by your right. You know, ideally, you have your industry expert on your right shoulder and your accountant on your left shoulder. You know, and you guys are just getting into the nitty gritty of whatever it is that smells like a rat. I mean, that's really, I know that maybe sounds a little bit like an improv, but deal making has a high element of improv associated. Yes, there's the obvious checklist you have to follow. And then there's the, okay, from that, what needs further investigation? And then once you really go down the rabbit hole and feel like you've answered all the important questions that needed answering, now it's your time to decide, does this thing still seem as valuable as I thought it was when I made the initial offer? 8 times or 9 times out of 10, it seems less valuable now than it did at the beginning. Usually the further you go down the rabbit hole, that to some degree, the worse it looks. It is what it is. And then at that point, you get to decide, do I want to discount this thing? So that's the diligence process in a high level nutshell. Follow up to that, or does that answer your question?
Yeah, that answers my question. But also, what is the deal team? What's their role in the due diligence or the whole like deal process?
That's a very large question. So I'm not going to attempt to tackle the entirety of that. Otherwise, we'll talk about that for the next 20 minutes or an hour. But first of all, there's tons of YouTube content, free content about that. So I'm not dodging the question. There's just like, I've made lots of videos about a deal team and like what their kind of core responsibilities are. But in the context of diligence, since that seems to be the kind of the point from which your questions are centered around. I mean, your accountant's going to help analyze all things financial, right? Balance sheets, tax returns, bank statements, credit card statements. Go down the financial rabbit hole, holding your hand, right? And then your industry expert's going to go down the operational rabbit hole as it relates to due diligence with you. Analyzing the contracts they're entered into, analyzing the customers that they're doing work for, you know, analyzing, you know, the software they have in place, that's whether or not you want to implement the software they have versus not, analyzing the SOPs they have currently in place to make a determination as to whether SOPs, standard operating procedures, how they do business. Like, do we like how they're doing business? Do we like their customers? Do we think this is a good business? Do we think these are customers that are going to pay well? Do they pay well? Do we want more of the same? Do we need to diversify our customer base after we buy this thing? Right. So bluntly, like macro, your accountant is helping you make sure the financials are as described. And your industry expert is helping you make sure that the operation is of a high enough quality such that you should buy it. Make sense?
Yes, sir. Thank you.
Thank you, Peyton. All right. I don't know if your name is actually Rachel Church, but Rachel Church.
Hey, Jason, Chance is my name, brother. How are you?
I'm good, man. How are you?
Yeah, I'm good, bro. I'm good. I just got a few questions, bro. So we're sort of at the I follow Dan a lot, bro, and we're at the stage of putting LOIs together for our board, right? And one of the questions, bro, I heard just now was that you only need 3 people on your board. I just thought I'd ask the question, what was your opinion on that? Why? I've already got 8 of us, and I'm sort of just curious on why that is.
Yeah. Okay, so I learned from Pena years ago, and I built a big, huge team. And many of you kind of know this story, so, and I've told it on YouTube at one point or another. But I mean, the long and the short of it, you ever been in a school project? I mean, maybe it's been a minute for you, been a minute for me, but once upon a time you were in a school project where there's 8 people to a group and 2 of them did all the work and the other 6 stared at you.
Yep. Right.
So that ends up being the dynamic that you'll usually find when you have too many cooks in the kitchen or too many members on a deal team or a board of directors for one. That's the big one. I would say on top of that, you get a lot of egos, a lot of personalities, at some point, the simplest way I can put it is too many cooks in the kitchen or too many people on a group project when I just need to get my core team of assassins that are focused on the essence of what deal making is. And then, oh, by the way, once you do a deal or two, if you want to bring on more support, now you can bring on another advisor at 0.25% equity versus 2.5% equity. You'll save yourself a factor of 10 in equity by having the patience to bring on more muscle going from 1 to many. In other words, I look at going from 0 to 1 as a very systematic process. 0 to 1 is not rocket science. Get in a good industry, go through the proper steps, which I've outlined many times over, get that first deal done, lose your deal-making virginity, if you will. And then from there, now for the first time in your life, you actually have leverage as a deal maker. From that purview and from that frame or position rather, if you want to bring on more people, now you're bringing on more people. Now they actually have more respect for you, because if you just built a deal team of 8, you know that you had to talk to about 100 people to get that 8 people. Of course you did, because I've been there and I've done that. So I know what that's like, right? So you got beat up and kicked around the corner and who the hell are you? And why the hell do you think you're going to do this? And I mean, you dealt with it. You know what it is. Once you actually have done a deal, 60 to 80% of that BS goes out the window. And now you can recruit a higher quality individual because you're a quote unquote made man now.
Nice.
So yeah, I just don't believe with that part of what he taught. And that's why I look at it a different way now from having done it myself.
Jason, thanks for your honesty. And I think I have a couple of resignation letters ready. But like you said, you are right. Just like to sit on the boat and don't like to row. But I didn't know that at the start. I think one of the main things is doing it, action. But bank finance, bro. I'm in a place called New Zealand, and we don't have SBA loans like you guys that I hear you guys talking about.
Right.
Do you or know of anybody that has done the same, say a 60-40 equity rollover model? So I've got a few potential LOIs locked in on a 60-40 rollover equity. But have you experienced that without an SBA loan?
Yes, the more I talk on the internet about doing deals, when I do talk, I have less and less time to talk. But when I do, I really try to be clear about the fact that I'm best at helping Americans, because it's the marketplace I play ball in. It's the specific sport I play on a daily basis. All right. Notwithstanding, I helped an Aussie do a vet deals some time ago. I know it's not New Zealand, but it's Australia, similar enough in some respects. And I help, Canadians have some success and Europeans have some success. I'm the best at helping Americans, bluntly. But here's what I'll say. I think your idea of rollover equity can work to fit. Yes. You're going to need a lot of seller finance / rollover equity. You're going to need a lot of help from the seller. You're going to need a motivated seller, because those other markets, to my understanding, just don't have the abundance of commercial debt like you're going to get with the SBA. Because the SBA, like for us Americans, a lot of Americans, like, you know, they complain that, you know, you have to raise 5% in cash for the equity and stuff. And, like, these Americans don't have any idea like how good we have it as a deal. I hear this all the time. Our marketing guy's running an ad and he keeps putting my stupid face all over the place. So like my same video like goes out 100 times. I'm sorry if you guys have seen it. I do apologize, but it is what it is. And so I get like the same comments all the time of like, oh my God, like I need to put 5% down. It's like people have no idea how good it is in America to do deals, where in these other first world countries, it's meaningfully more challenging. But to that end, it all starts and ends with the same thing, which Pena will have taught you, and he's right by this: motivated seller.
Yeah.
The office deal I'm thinking of in particular, it was a classic Pena special. Those of you who know Pena will know what I'm talking about. The seller was literally on his deathbed and needed to sell the business before he passed. And so financed like the whole kit and caboodle with my client, and he bought that business and he was off. So like, it's kind of brutal, but you know, that kind of motivation undoubtedly spurs a transaction with a higher likelihood. So what do you do with that exactly? Make offers that you believe you can get done. I'll give you one of my mentors, actually a deal, a member of my board, if you want to call it that, for my first business, Brighter Living, gave me this advice, which I think is really good. Make offers that are low enough, that are enough in your favor such that you feel a little bit embarrassed when you send them. That was his advice. Make offers that are low enough such that you feel a little bit embarrassed when you send them on. You know,
Jason, that's how I feel. Making deals in New Zealand.
You're gonna have to, man. And do you know what? Here's the good news. Others are dealing with the same marketplace dynamics. Other buyers are dealing with the same thing you are. Like it'd be one thing if you were making those offers in the United States. Meanwhile, 50 other people saw me ranting about the SBA and how to structure an SBA deal. You'd get blown out of the water by the other 50 people on this call. All right. But in New Zealand, that construct doesn't exist. Thus, it's a different market dynamic, and you can hold the line and say to the seller, well, I'm sorry that's not the way you like it. I hope you took enough earnings out of the business while you were operating. Help me be a part of something better by keeping equity in the business and getting paid out over time and da-da-da-da. This is what it looks like. Well, I don't like that. Well, then I guess you're going to die with the business, huh? Like, you know, you can make it a little bit nicer, a little sweeter, but like, you know, at the end of the day, it's like, you know, I'm not God. I don't make the rules. I'm just playing by them, right? It's like,
yeah, it's good. Yeah, it's good.
Take it up with your local congressman. What do you want me to tell you? Like, there's not an SBA program here. There's not government backed. Here's what the SBA is for us Americans that don't understand this. The good faith and credit of the United States of America is literally holding up of dollars in SBA loans right here. Trillions of dollars of SBA loans they're holding on their damn shoulders, knowing full well that not every single one of those loans will work because some people take out these loans in goofy conditions. And yet the government guarantees the first 75% of every SBA loan. So that even if somebody takes on an SBA loan and completely just goes AWOL, that there's only 25% of that loan that has exposure. Well, most businesses can provide 25% of the collateral between the aged receivables and the inventory and equipment or machinery and the vehicles. In other words, it's a mortgage, right? How far does your lender go for, you get a $500,000 house? Well, let's do $1 million house. You get $1 million house. How much is the mortgage? 750 grand, right? Is about as far as the lender's going to go. Yeah. 75% LTV, loan to value. That's what an SBA loan is. It's a fucking mortgage, my friends.
Wow.
That's why it works, because the government provided the first 75% of the collateral. It's literally, you can become a business owner and buy multiple 7-figure businesses on the backstop of a fucking mortgage. It's built to buy businesses and to actually build meaningful net worth. And then I get people complaining that I might have to put 5% down that I raised from, my attorney's brother or something. It's like, and that's your problem. You know what? You deserve to be, whatever miserable job you have, you deserve that. If that's truly your purview, from my vantage point, I don't mean to be offensive, but if it does, so be it. Like, how much better can it get? The United States of America has like the lob toss of a lifetime as far as creating wealth through buying businesses, and people are looking for a reason not to do it. That's my honest take. So,
That's good, Jason.
And just to clarify, 5% is required to obtain a SBA loan, right? So
there are
5% of
examples where
total.
you can wiggle around it, Roman. There are examples where you can wiggle around it. If it's an expansion loan, you can wiggle around it. Normally, you need 10% of the purchase price to be equity in an SBA loan, half of which can be a seller finance note on hold for the life of the first position note. I know that's geeky and technical. I have a bunch of YouTube videos explaining what that
I understand it. Yeah.
Okay, good, cool. And then the other 5% generally should be cash. Now, there's some new SBA rules that just came out as of August 1st, where you can put 2.5% down in some instances, and you can get the seller. There's like a bunch of like geeky stuff that, to be frank, I haven't even gotten my head fully around because most lenders aren't operating. The SBA has all these like little technical rules, and I'm not going to even pretend to love all of them or like know every single intricate detail of all of them. I like advising people to put together standard cookie cutter deals, because that allows you to pitch your deal to the maximum amount of SBA lenders. In the context of what you're getting, 5% of the purchase price in cash is a very small amount to raise. So yeah, just I think for all intents and purposes, expect 5% of the purchase price to be in cash, 5% to be on hold for the life. You can even put it on hold for 2 years if you want to play that hand. It used to be on hold for the life for its account as seller's equity. Now it can be 2 years. For those of you that don't know the details of what I'm talking about, there's a bunch of SBA videos that geek out about this a bit more, because I know for some of you that are new here, you're like, oh my God, this guy's using a lot of jargon. It's really not that complicated, but there's a couple of these key phrases that help grease the wheel to get these deals done.
What is the total amount of limit on the SBA loans?
Now they're starting to say things like you and your spouse can each tap into 5, or you and your business partner can each tap into 5. The base answer is you have 5 million of powder. That's the standard answer before you get clever. There are people that I know that have gotten clever that have been able to expand that out to 10 or 15 mil. There's also the SBA 504, which is more for real estate and stuff like that, which I'm not going to talk about the nuances of. But blunt answer, 5 mil, asterisk, there are ways to get more, but it's a little more technical. So, Jason Pulliam. How's it going, partner?
Good, man. How are you?
I'm good. How are you?
Groovy. Thank you for taking my question. I'll keep it brief.
Sure.
Is it possible with the SBA to overfinance so that we have working cap when you take over the business?
Not only is it possible, it's something I would be, militant about.
Okay. Is there like a particular limit that you would suggest, or is it based on the vertical that we're in?
It's based on the vertical you're in and the balance sheet that you're, it's based on a number of factors. I have a couple of videos on YouTube that talk about some of these things, like age receivables and age payables. Like if you're buying a business, without geeking out too much, if you're buying a business that delivers services before it gets paid, that's a really important component to think about when you're financing a business acquisition. I know from personal experience, I screwed this up for my first plumbing deal I did. Okay, so this is where an accountant is really important to help you analyze the balance sheet. But normally you can get the lender to abide by up to 3 months of operating expenses for your deal. Up to 3 months is kind of the max that they'll go by. One thing is, if you're Jason, if you're buying a business that does have aged receivables, AR, I recommend everyone Google AR after this call, or take note of it. Really important finance term to understand if you're buying businesses. If you're buying a business that does have AR, try to get it included in the purchase price. Because if you don't, what happens is for the first 30 or so days after you buy that business, no money's coming in. really terrible experience. And I speak from firsthand experience. I've been there. It was a cold, dark, lonely 30 to 40.
Yeah, it's not fun to miss payroll ever.
Oh, you can't miss payroll. That'd be the last thing you ever.
It's the last thing you want to do.
Yeah, that's it. So
Yeah, that's not gonna fly.
Yeah.
people don't take all that kindly when their check doesn't clear on Friday. It's the damnedest thing. I don't know why.
Yeah.
So look, be mindful about managing cash flow. That's what this conversation's about. But understand how much age receivables the business has. I generally recommend if you take a snapshot of a business at a given time, say a business does, let's use a simple example. I'm gonna do a screen share here. Let's say a business does 2 million in sales. Can you guys see my screen?
Yes.
Okay. And then it has 2 million in sales and it has 200K in AR, right? Age receivables, monies that you're owed for services you've already provided. How many days on average is this business taking to get paid? Well, you take the 200 divided by the 2 million, that equals 0.1, right?
Mm-hmm.
Take 0.1 times 365 because there's 365 days in a year, right?
Right.
On average, it's taking this business 36.5 days to get paid. That's how long, if you don't buy the age receivables, it's going to be until this business starts getting you money.
Wow.
Pretty interesting when you look at it from that perspective, right?
Very interesting.
You can see how that could be a problem.
Yeah.
Again, I learned this one firsthand, and I feel it's my mission on this planet to help others not go through the same bullshit I went through, because it was a tumultuous time.
Appreciate it.
So that is a nice little cheat code to kind of get a sense of how long it takes for this business on average to get paid for services rendered.
Okay. And
yes, sir.
Can we use credit partners to do SBA, or do we need to be the applicant ourselves?
You can have additional credit partners. Usually they're going to want something for it. Family is the one exception that'll usually sign in uncomfortable places without asking for anything for it. Otherwise, the further
You're already ahead of me.
Yeah, if there's not that thick blood running through the relationship, usually people want a meaningful something in exchange. I mean, it's just business.
Sure.
The SBA will love to have other people come on and sign, but I mean, here's the thing: position yourself with a 700 plus credit score if at all possible. You don't need to have a lot of liquidity to get a deal done. Personal liquidity, though it helps, but I know from firsthand experience that you don't need to have a lot of personal liquidity to get a multiple seven-figure deal done. A little easier if you want to be the only guarantor. If you want to be the only guarantor in an SBA loan, there's a couple of things that will really help you do that. Again, firsthand experience. Number one, 700 plus credit score. Number two, if you're not an industry expert, have a really solid industry expert on your team. Number three, make sure that somebody on your cap table has the licensing needed to operate in the state that you're operating in. That's another big one. They're always worried about licensing. Then number four, knock your underwriting call out of the park. Bring your A game. Have all the right answers, which is we could have a long conversation about that. But at the end of the day, like, be good. That helps as far as you interview. And I could again talk at greater lengths about that, but I can't pretend that's not a variable. The slicker you sound and the more sharp you sound, the better. And then do a deal with a very aggressive SBA lender. Look at an SBA lender that's doing a lot of loans, but also be mindful of SBA loans that are too well known for their own good. In other words, they have so much deal flow coming their way that they can be picky, overly picky.
Okay.
Live Oak Bank is the pinnacle of that.
Okay.
I'm not a fan of Live Oak Bank. I shouldn't say Live Oak Bank in general, but I have had some poor experiences with Live Oak because they're the number one producer of SBA loans. My view of Live Oak is they get so many loan inquiries that they can afford. They have so much deal flow that they can afford to cherry pick and kick your application to the curb.
Okay.
That's been my experience.
How does that compare to Key Bank?
I'm sorry.
How does that compare to Key Bank? Just out of curiosity.
Key Bank?
Yep, Key Bank.
I cannot provide a positive or negative comment on Key Bank.
Okay.
So no comment. All right, Jason.
Thank you, Jason. I appreciate you giving all this value tonight.
Absolutely. All right, we're gonna get to a few more of you. We're gonna get to John. We'll get to you, Jonelle. We'll get to Joel, and we'll get to AJ. John, how you doing, partner?
Doing great, Jason.
Good, man.
I'll get to the point. So, you know, I've been going through a number of sales. You've probably gone through 100, if not 1,000. You've got a person that's cold calling, looking at these deals. What is the fastest way you figure out quickly if it's a non-motivated seller? And do you even waste any time with sellers that don't know what seller financing is? You know, I mean, I've met a lot of people that purchase their business seller financed. You know, I say 60% of these businesses. So those are my two questions. How do you quickly filter out non-motivated sellers?
Let me
And
answer
do you
that first.
waste
Clean
yeah.
tax returns in a business listed at a fair market asking price.
Okay, so that's from the visual.
Yep, let the fundamentals tell you. The fundamentals will usually tell you a lot about somebody's level of motivation. If it's an on-market deal, if it's an off-market deal, then as soon as you get the fundamentals, make a fair market offer or a slightly below fair market offer, depending on how you want to play your hand. And at that moment in time, their response will tell you most everything. In other words, just I think let the fundamentals drive that decision. Because you know what, the more I learn about people, the more I realize people are highly unpredictable and their actions are the only thing you can truly judge. So take actions that force them to take actions in return and watch their actions and use that as a determinant or to decide, or let that be the indicator as to their motivation, as opposed to trying to look for their pupil to dilate or for them to look in the top left corner or like some of this kind of.
But I mean, like, you know, you've got a guy that does like hundreds, if not thousands of calls or looks at filters. What's his filter real quick? He looks at tax records match.
Yeah, like it's exactly, I know it maybe doesn't sound that sexy, but it's exactly what I described. Like if they're serious, they'll send us their financials. Like that's number one. That's the first great vetting process. Like if it's off market, okay, hey, we need this, and that. First, we're going to get you an NDA. Do they sign the NDA and send it back in 6 hours?
Perfect. Okay.
Right? Like compliance, in other words.
Okay, got it. Yeah, I noticed that too. Like as I go through them, it's hard to understand what motivate is until you go through a few and you find the difference. And then how quickly do you ever bother dealing with someone that doesn't understand what seller financing is? You know, like that seems like a losing battle there.
It's not, this is the benefit if you're trying to move fast of on market or pocket listings, because those folks have been educated as to the basics. Whereas if you're having to explain like what seller finance is, that's a bit of a different coyote, man. I mean, that like only you can truly decide if you believe there's a play that can be had. But I mean,
no, I just feel like it's a waste of time because you're trying to educate someone. Because I notice the seller finance deals are people that have other businesses, right? They're maybe they're doing better in, and they just want to get rid of something. They already know what this is, and they're really willing to work with you.
I sentiment, like if nothing else, know that it's the long boat to China at best. If you're having to explain what seller finance is, you're playing the role as of the buyer and the broker and the advisor and the uncle. I mean, basically, right? There's a lot going on there. So yeah, it's going to be a longer boat to China, undoubtedly. Now, if it's a great asset you really covet, then maybe it's worth it. I mean, bluntly, like, you know, to use a bit of a dating metaphor, like, is it the woman of your dreams, at least visually, or is it not? Like, you might be willing to do a little bit more if it's something that you really covet. Asset.
Yeah, I've been taking the approach, look, you know, it's your price and my terms, or my price. And since interest rates are so high, I'm not saying it's half, but it's substantially a lower number if they're going to name the price and try to keep their terms. So I found it as a good negotiation. The one issue I see right now is people are so because obviously I'm looking at car washes, and it has to do with land value and has to do with this blow off top market. People's realities are very skewed, right? So they have an assessor that says, hey, your business is worth 2 million, 3 million, and the thing's been on market for 500 days, 300 days. And
We're
I'm starting to see people
hard asset businesses, by the way. Unfortunately, one thing, and you're experiencing the shit end of this, but it also will be nice to you once you crack through. Real quick, John, I think for everyone, you can see my screen real quick here.
Yeah.
Easy, harder. Sorry for the, and you can call this the goofiness, the goofy money. This is goofy money, and then this says harder, this says easier. So the easier the operation gets, right? This is car washes would be considered easy. Laundromats fall fairly high on the spectrum, right? Real estate is obviously way over here too. Tends to attract the especially in good times, or to the degree people can hold out, they have the goofiest money perspectives for the easiest businesses to operate, is a general matter. So you're, I think, experiencing that to a higher order than like we are, bluntly. But everyone will experience some of that. I think that we're on the back nine of the goofiness. There's no more free Joe Biden, Donald Trump kind of monies that are showing up in people's mailboxes like there was. So hopefully we're on the back nine of that. Liquidity is continuing to become a more prized commodity. But go ahead, John. I just thought I would create that.
No, I just, I'm starting to see, like I told you, I recently bought a car. They were trying to charge me like 30K above MSRP a few months ago. And then last month I bought it for 10K under MSRP. So like you're seeing people mind shift. It hasn't happened in real estate yet. And I think some of the valuations some of these guys were getting that blow off top, they're still stuck there. And they're getting offended, by the way, when I send some of these offers. But the offer I'm sending them, and I've looked at the market cycle, I saw car washes that sold for 3.7 2007, then crashed to like 900K and built back up. So like it almost went back, and they're trying to sell 4.7, right? I saw just even a lot that was ready for a car wash, and 2007 it was for 450K. It dropped to like 200K in Florida, in Orlando, until recently, and some guy bought it for 450 and he's trying to sell it to me for 3 million, right? So there's this huge valleys and troughs between these market cycles. Another thing is, I wanted to ask you is, have you ever seen a business where the owner really milked a lot out of the business and they didn't put up much money back into the business? And what I'm trying to explain to the owner is like, well, if you had put money back in the business to increase the revenue substantially, it'd be worth more. But you've kind of sucked it all out. And they're like, well, I'm just giving the business away. I'm like, you're not really giving it away. You've made money for like 5-10 years. And now you're just handing it over to me. And I'm gonna basically take it off your hands. Just transition. Are there businesses that really don't, you can just tell the owner, look, I'm going to basically buy it from what you paid for it, and I'm going to take it over. Like, I don't see how much more value you've generated in the business. Or are they always expecting to suck that much money out for that many years and then leave with also,
generally the
pot of gold?
Yeah. What I have noticed, 0 to 1, it's funny. And I maybe this sounds dickish, excuse me if it does, but the problems that most of you are describing are particularly acute in the 0 to 1 phase. Like trying to get your first deal done, unfortunately, like all the brokers and all the sellers, like the whole market just tries to like throw the BS at the first time buyer, because it's like, if there's anywhere to like throw the garbage, it's like on somebody that doesn't even know what it is. And then to that point, once you get in the game, that's when you get the broker to call you to be like, hey, there's this like super motivated seller. They're a bit distressed for X or Y or Z reason. Like, this deal needs to happen fast. I'm calling you because we know you're a player and you can perform. So, you know, maybe that doesn't warm anybody's heart, but what I'm getting at is if you can do a deal that's serviceable. I see a Jake Hargrove talking about making sure your deal is serviceable in the chat. If you can do a deal that's serviceable, maybe not a home run, but it's a solid get on base, single or double, you then will start to get tailwinds as opposed to headwinds. Because at the end of the day, positioning and marketing yourself and making outbound calls and all those things, it's important to try to optimize for that. It's also true that the ultimate resume for deal making is a resume that includes deal making on your resume, right? So, and that's going to be the number one thing that gives you access to some of these actual kind of deals that really are.
I'm just wondering if I'm being too aggressive. Like, have you ever seen a deal where, let's say someone bought something for 500K, they overpaid a little bit. Then they finally got up to where it's maybe worth $1 million, but I'm like, you know what? Right now in the market, it's not worth $1 million. I'm going to give you 500K. You can get out of this thing. I'm going to take over.
Yeah, I had a client, I recommended he pay about 1.1 for an assisted living. And he really wanted to pay like 900. And I was telling him, I was like, dude, it's a pretty damn, it had clean financials. It was a tidy deal. It was in a decent market. It wasn't perfect, but I was like, I basically told him, don't over negotiate a good hand, but it's your prerogative. I'm an advisor to you. And you know,
yeah, but have you seen a business where a guy's like,
just to finish that point, because it ties into your question, he offered the 850 or 900. Somebody else offered the 1. And then he's like, oh my God, he texted me. He's like, I can't believe, do you think this was BS? Like, and I called him. I was like, no, dude, like, if you want to beat down a deal, you beat down the deal in diligence, not on the front end. So if it's fair market price, I use the phrase, get the deal pregnant, get it off. You have a girl you're talking to, like, you know, take her to the corner of the bar. Like, what do you don't want to dance with other guys. Like, you like her. You like her. What do you mean? What are we all like playing hanky panky in the bar room and doing a two-step with all these other, no, come on now. Covet, take that thing which you covet and kind of and get it off the table. So like, John, I guess without a little bit more detail, and I know obviously you and I've talked in some detail, so but that's beside the point. In general though, if it's fair market, offer fair market, get it off the table, under contract, and then the time to beat up a deal is once you're under contract, not on the front end. In other words, the get the deal pregnant strategy, I think, is generally advisable, especially 0 to 1.
Yeah, I got this one semi-pregnant, and then I found out there's like that 35% drop off in revenue. So now she came back to me. By the way, she was offended and she was cursing in Spanish. And then she came back and I'm like, don't be offended. I'm just giving you the raw numbers. It took her a week later and she came back. She goes, I want to do a deal with you.
So now she wants to do a deal.
Oh yeah, and I'd like a third the price.
Well, good. The old takeaway close. We were talking about this earlier. Some of you who've been on the stream for an hour or two.
But I was trying to convince her, look, don't feel like you're not making money. You made money for years. I gotta like buy this thing and put another 200K into it to improve it. And you can't sell for the price that it would after I make it successful, because then I have no motivation to buy it. But I'm just wondering if there's businesses where like an owner, like I met one advisor and he's like, I just went in, this guy had this car wash 70 years or 60 years. He's like 75, 18 or something. He started car wash and he just wanted to hand it over to somebody else at a fair price and walk away, not try to make a huge multiple above it. He just want to get out. And like, those are the kind of deals I'm looking at a minimum, but I'm just meeting so many people that are just looking for crazy numbers. I'm like, how do I make money? You basically want to sell me something where I sink. It's not going to work. And I back them in the numbers and they just like, they don't get it. You're offended because their appraiser said it was supposed to be so big, you know, and there's a lot in the market.
there's a big dynamic at play here. I wish it weren't so. I'd make my job easier on this call if this weren't true. But generally, the BS gets pushed upon first-time buyers. Whereas the more rational reason, like the pocket listings, tend to go to actual market participants. It just is. It's not a warm, fuzzy truth for those of you that are 0 to 1 trying to get in, but usually what's like the Jordan Belfort and the Wolf of Wall Street, where he's talking about penny stocks, and he's like, and now we offload the bullshit, and he's like selling all those like pink stocks or those like pink slip stocks to the, like, sorry, but they offload the pink slips to the first time buyer. So yeah, like it's not fun, but it is, at least you're aware. So you're not buying into some BS, and you walked away from that deal, and then what a concept. Now she's coming back on her hands. Last comment, John, before we move to AJ, Jonelle, Addy, and Larry. Anything, John?
Oh, no, just what I see the market turning here. So I mean, this maybe to the audience. I mean, I think the entire market, not just stock market, crypto, everything has been in a massive 15-year bubble. I think in the next 6 months, I think everyone's gonna have a chance to negotiate down. People need to kind of choke on their prices and 600 days on the market. And then from those, you're going to find someone that's motivated that wants to offload some businesses. But I think the next 6 months to a year, next 2 years, even 3 years is going to be some great buying opportunity once people get to reality. I'm just starting to see us crest over that hill. So
yeah,
so I think there's some good
deals. A lot of
deals.
money out there. We've seen in the HVAC side, most of our systems this year that we sell are financed. 2 years ago, even a year ago, only 10 or 20% of the HVAC systems we sold were financed. Now everybody's financing. So there's just not the same liquidity that there was. It's a different economy, but I think that's good for buyers.
And PEs, and I would say to Jason, PEs, the ones that had all that free money, a lot of them are getting in trouble right now too. So that's the other thing that messed up the market with the car wash is like they're paying 10 to 15 times EBITDA, and they didn't care if it went from 50% margin to 1% margin. As long as they could roll up 100 of those quickly and go public, that's what they were doing. And so people had that perception that, hey, I saw my friend sell his place for 15. Why can't I sell for 5? And you're like, that was crazy money. You missed it. Sorry, buddy. Don't get offended when I offer you 3 million for your place. Anyway, so those are some things that are changing.
Yeah, I share your sentiment. Appreciate it, John. Cheers, man. We'll be in touch.
Thanks, man.
We'll talk.
Yeah.
AJ. And then Jonelle. Paris. But you're up second. AJ, are you there?
Yes, I am here. Sorry about that.
What's going on, man?
Good evening. Thank you for taking the time to chat with us. Appreciate it. Sorry I can't turn on my video right now, but my question was kind of following up with Juan's question earlier. Wanted to get a little more information about the structuring of, let's say, like your S Corp. You mentioned, staying in the same industry, which is great. But more so, do you, if you already have a holding company or S Corp, and you buy a company now, are you creating a separate one, or how does that work? That's the first part of the question. And the second part of the question is, you strongly recommend keep staying in the umbrella industry that you're already in. And even if you're doing that, once again, I wanted to expound on that GM role question he had as well, which is, yes, you want to get involved. Yes, you want to have a GM. But I guess to be more specific, my question on that was, what does that relationship look like as a first-time buyer?
Okay, let's tackle the first one. Okay, I'm not going to get into the S Corp versus LLC conversation. I'm going to talk about parent. That says parent. Okay. And then the parent subsidiary relationship. Okay. Each of those say sub for subsidiary. This is where you hold your equity. Maybe you hold 90% and your lawyer has 3, your accountant has 3, your industry expert has 4. More likely your lawyer would have 4 over anybody else, but whatever. You guys hold the equity here. Okay, this is your parent company cap table. And from there, and I'm going to make it a different color because this isn't another entity. That's the cap table for the parent. You can see my screen, by the way, right? Anybody?
Yes.
Yeah.
Yes.
Making sure I'm not drawn for nobody. That'd be fun. Look a little bit spacey over here. Okay. So then, you're going to, when you buy Bob's painting business, Bob's painting, maybe you bring on an investor. The investor takes a 10% ownership of Bob's painting, and then the parent company owns the other 90% of Bob's painting. This, in the nutshell, is the dynamic from which you're engaging in, right? You own 90% of this parent, and then in this dynamic, maybe the parent owns 90, and your investor owns 10, right?
Yep.
And then you replicate this. What's nice about this dynamic is it keeps you from diluting here. You avoid dilution here. This is what matters. This is how you keep the rudder of your ship, man, so you can keep sailing straight. Versus if you lose your rudder because you go down to 45%, then now you start having to do votes. You need votes to get stuff done.
Right.
And that's a scary dynamic. So in a nutshell, that's that. Now, I'm not a lawyer, so I like not to pretend that I have all the answers for all the nuance of S Corp, LLC, structuring this. I'm not a lawyer, talk to your attorney. I mean that sincerely. But that's the punchline as far as kind of a macro one-on-one on structuring a kind of an org chart. As for your other question about, the dynamic or the relationship you'll have with a GM or, with an operator.
Exactly what an operator, yep.
Yeah, I mean, my sincere answer is every relation. I have 6 or 7 operators that report into me. One's in Nebraska, 6 or, well, really, I'm trying to think. I've got my guy in Nebraska that handles the property out there. I've got 4 core operators here in Florida.
I can clarify that question too, by the way.
Sure, so, ask a little more detailed.
Yeah. So my question is, first time doing this, first time doing it is, I guess and once again, I know it's going to be different with every deal, every business, every scenario, but if you have an high level answer to this, what the question is, I think what I'm more curious to know is what is the limitations or boundaries in the role that you'd be coming in? I guess
what boundaries do you impose upon them?
Well, yeah, as far as the boundaries that are on yourself, as far as you letting the operator be the operator or letting the GM be the GM, what boundaries do you put on yourself in that position as someone coming in?
I'm not trying to, but I don't understand. I mean, I don't really have boundaries, right? Because I'm effectively the boss, so I can do that which I want. Now, what I think I understand your question. Let me answer it real quickly. I'll take a stab at it, and then if you need a little more clarity, ask. But look, I try not to micromanage my people. I believe in the idea if you give somebody a rope, they're either going to tie a noose for themselves and hang themselves, or they're going to create a knot that's going to help us cross the river.
Right.
So I like to give people some rope, watch what they do with that rope. If I see them starting to tie a noose, I'm going to start asking detailed questions about why are you tying that rope and putting it in a circle and then getting on a plank and then putting it near versus oh wow, that looks pretty creative. It looks like we're finding, oh yeah, we're going to whip this over and cross the river and and conquer the kingdom. Great. Can I help you? So I'm generally just being observant, but giving them rope. But then also, usually you can tell within 60 to 90 days if somebody's goofy. When they are, you need to move swiftly.
Okay. Okay.
I mean, the simplest thing I could tell you is give people rope, but when they're making a noose to hang themselves, it's time for them to exit stage left.
Understood. All right. That's it for me. Thank you.
Ferris. How you doing, man?
Fantastic. How's everybody doing tonight? Jason, thank you for the time. As always, wanted to check in just with where we're at, just on the economical climate. Do we see, are you seeing anything from your perch over there in regards to, rates, in that regard?
I mean, I'm seeing what everyone in the market's seeing. We just had rates go up 25 basis points, if I'm not mistaken here, recently enough. I think we're on the back, now I'm hypothesizing, but I think the rate hikes are close to done. The data, I've been skeptical of the Fed data, but in the inflation data over the last few years, but the CPI and core inflation, it's come down quite meaningfully.
Okay.
The data suggests, and I do believe that to be by and large true. I don't think you're going to see rates go too much higher. Do I think they're going to come back down to 0% anytime soon? No. I actually think it's better to do deals in a higher rate environment than it was a 0% environment. People don't understand that or don't sometimes agree with me because 0% just feels, easier to digest, but
nice and safe. Plushy.
It's like when you have a 0% rate environment, everyone and their brother is a business buyer and everyone's making cowboy offers. And that dynamic that John was talking about in the car wash business, that was pervasive in every business back in 2021. Like 2021 was like everyone was drunk with a bottle of bourbon in their hands, just like strolling. It was like Bourbon Street in New Orleans. Everyone's just out there like, oh, let's make it offer. It was debauchery in a purest sense in a business buying context.
Hey, Andy, you good?
1 second. Whatever that was. So I don't think the higher rates is a bad thing. Again, I actually think it's a good thing. It weeds out those that are serious versus those that aren't.
Adds a moat, in a sense.
Yeah, you could call it that. Actually, I think that's a fairly good definition. And the back end of it is earning multiples do have to compress for in a higher rate environment. But now it's not like the rate. We've been dealing with rate hikes for the last year and a half. They started.
Yeah.
So it's been 18 months of rate hikes. So it's not like any sellers can. Thank you. It's not like sellers are completely unaware that rates have been, consistently climbing over the last 18 months. So it's not a new, it's not the Band-Aid just got ripped off phenomenon. It's like there's been a minute for that process to happen. So, I mean, what can I say? I think it's an important time to be mindful of what industry you're going into. I think asking all the right questions about, is this business recession resistant? Is this a market I feel comfortable and confident in? I believe demand will be pervasive in this business I'm buying. I think those kinds of questions are always important ones to ask, but I think they're particularly important when the economy isn't raging. And I would rather be dealing with problems in the economy in some form versus 2021 when the money printer was like stuck on print mode and money was flying from the sky. I'm telling you, as a business buyer, it's easier to operate in an economy where there's some imperfection than when everything's just so red hot because the valuations go to the fucking moon. And then what happens if you're not careful is you buy a business. Most SBA debt, by the way, is variable. So you buy a business at a high valuation at a low rate that's variable, you overpay, and then you ride the rate up. You're the loser. You're the one that took the loss on that. Whereas when you buy at a lower multiple in a higher rate,
higher rate, yeah.
Now again, this is speculation. I can't guarantee this to be true, but I think most would suggest and believe that the majority of the rate hikes, if not maybe all the rate hikes, are done. We're in the back nine, I think it's fair to say. So the odds of you having, extremely sharp rate hikes happen over the next 18 months are certainly lower than they were 18 months ago. I think everyone on this call would nod in agreement on that statement. So look, be mindful of economic risk, but carpe diem, seize the day, nothing ventured, nothing gained. And like we were talking about with that fella from New Zealand, for us in America, it's like it's a lob toss opportunity to take advantage if you're an active market participant. It's there for the taking. All right. Hey, if you're not talking, if you don't mind yourself.
All right, cool. Thank you, Jason.
Anything else, or is that?
It's a quick one. That was it. Thank you.
Addie, you there? And then Larry.
Hey, I'm here. Can you hear me?
I hear you, partner. How can I help you?
Thank you so much, and thank you for your time. So what I wanted to ask is in relation to the New Zealand guy who is a foreigner. Similarly, I'm a foreigner. However, in my case, I'm already in the US, but I don't have access to SBA. But I understand deal making. I understand accounting. I can read financials. I mean, I got the guts to speak to sellers, speak to brokers. I'm able to negotiate some seller finance. However, in some cases, I still require SBA, mainly because the sellers in the US are quite spoiled with the availability of the SBA. So now what I want to ask is there a way to gain like partnership with individuals who have access to SBA to do deals together to be able to overcome that hurdle?
So short answer, I certainly think so. Disclaimer, the immigration side of the business buying world is not my sweet spot.
Okay.
I categorize this question as something of an immigration question, right? Because we're talking about citizenship or lack thereof, but I'm here in this country and SBA rules and regs with regards to basically an immigrant doing a deal here without the US citizenship. It was easier before 2020 when a certain little virus, hell, you can say it here, we're on a private stream, when COVID screwed everything up and everyone got nervous and international trade halted and international travel halted. I'm sure we all recall.
Right.
Some of that stuff I think is coming back. Here's what I would do. I would just call a handful of SBA lenders. Go to the top 50 SBA lenders list website. Anyone can find it. I'd call 10 or 15 lenders over the next week or so.
Okay.
And just basically say like, hey, if I brought on a partner who's a US citizen who and we do a 50-50 deal for an SBA acquisition, like, would there be any problem with me being a 50% holder on the deal? Or an 80% holder, but he's a 20 and he guarantees it, or however you want to describe the specifics. I would go right to the source is what I'm saying. Because as a citizen, I've not had to go down the rabbit hole of getting the answers to those questions. And more, I really try not to dip my toe in areas that I don't belong. Not that I don't belong, but like that I'm not an expert in. I'm not an expert. I think you can. But I don't want to come here and just like, of course you can get it done. And then you build this whole like 6-month game plan based on me running my mouth at 11 o'clock at night. And then you're like, oh yeah, like it doesn't work. So just like go down that rabbit hole, but I'm pretty sure you can. There's just a lot of SBA rules and regs that have literally changed in the last 90 days. That's part of it too, is like this, it's kind of a constantly moving target. So,
cool. Okay. I'm gonna explore that then. Thank you.
I think your instincts are totally right, though, by the way, Addie, insofar as markets are smart. Like market participants know what the market has to offer, right? So in the States, sellers know if they have a business, they do their homework to be like, they call, they talk to people like how do these businesses get bought and sold? Oh, there's this thing called the SBA. Like, oh, people talk. So when you're dealing with a market that has a current, or a certain opportunity, sellers are going to be mindful of what that is. And then for you as a buyer to be able to actually transact in this country, I think your instinct is spot on that, like, hey, you can have all the knowledge, know how to read financials, know how to negotiate, be a wheeler and dealer. But, it's kind of like having bows and arrows when the other side's using a Smith and Wesson pistols. It's like you can be the best aim, you can be the best marksman in the world, but if it's you with the bow and arrow and me with a 6-shooter,
no competition.
Yeah, man. It's just, you can be the best aim. I can be a monkey as an aim, but I bet on myself, right? So I think you're right. If you're gonna be playing with guys who are shooting Smith and Wessons, then get bullets. So
Yeah,
I think you're on point. Make it happen, Captain. I love your energy. The immigrants hustle. Make it win. Immigrants run laps around, third generation, chunky Americans that are lazy and want handouts and, all the frailties that us Americans who have lived here for too long have. Norman Ho, excuse me, buddy, but we got it. Yeah. Okay. Very good. Larry, we skipped you earlier.
Thank you so much. Thank you.
Of course, Addy, you got it, man. Make it happen. Love the immigrants hustle. And Larry,
Thanks.
how's partner? I got to roll in about 5 minutes. I've got an 11 o'clock call, so let's do rapid fire, and then anyone else has to do. But go ahead, Larry.
How you doing, Jason? Thanks for getting me again. I had some technical difficulties earlier. First of all, thanks for taking the time to do this Zoom. Thanks for the last 2 years. I've been following Dan Pena. I followed some of your content that you've been doing since the pandemic. It's definitely been very inspirational and very helpful from my end. I definitely started building a board of directors myself. I'm out here in New York City. I've been finally able to get a certified personal accountant on the board. I'm looking to do a roll-up of the home healthcare industry. And my question to you is, where would you say would be the best places or locations to contact investors or people who would be interested to raise the funds to close multiple deals for these roll-ups?
Where? I don't think geography is the defining characteristic. I think the job description or let me give you the right answer, okay? In my opinion, medical doctors, lawyers, individuals that are making between a quarter plus a year, in other words, who are accredited investors. I think that's your sweet spot. Accredited investors. Again, those are going to be kind of white collar professionals. LinkedIn outreach, you can hit that all day long. But before you just start spamming the internet, and I talk about this, I've talked about it on the internet, but in 30 seconds, I'll give you the pitch. It's basically like, go to all your friends and family and your deal team and anybody around you that knows you on a first name basis and say to them, hey, look, I'm working on this pitch. I want to get your input. Then give them your pitch. Give them your 30-second elevator pitch for why they should invest and why they should write you a $50,000 check to invest in your healthcare deals. One of two things is going to happen. Either their pupils are going to dilate and they're going to look like they just saw, Jesus walking on water because your pitch was slick as a rick. That's great. If you get that reaction 3 or 4 times in a row out of 3 or 4 times, then you're doing something right and you're sharp. So now it's time to go spam the world because you have some beautiful gospel from which to be on top of the mountaintop and preach, right? People are going to want to hear that. Whereas if you get, your friends and family being like, wait, what? I don't even understand. Like, they're scratching their head, their eyes are rolling over, they look like they're, bored, then pause. No need to reach out to everybody and their brother. You need to keep perfecting that pitch until when you make that pitch, people are engaged, like really captivated. And they start saying things like, wow, like that sounds like a great opportunity. Like, how much did you need again now? Or like, da-da-da-da, like, can I use my IRA? Can I use my 401k? Like, do you think so? Like, would you? I remember when I made that first pitch when I was starting Brighter Living, when I was so broke, and I brought it up to friends and family, and I got a couple of the people in my immediate network that were like, wait a second, like how, I got that reaction of like, how exactly, this is kind of interesting. And then next thing you know, I was spamming LinkedIn. I was hitting up my whole deal team. I was working my immediate friends and family network. And then what you get when you do this right is you get a multitude of investors competing for a limited number of spaces on the deal's equity side of the cap table, or basically you have X number of dollars you need raised, and you have more investors looking to get those limited number of spots. That is the holy grail you're solving for. But it all is dependent. You can have the best, you could reach out for weeks and days and months and years and all of this. But if your pitch sucks, if you're not compelling, it doesn't matter where you're looking. So yeah, LinkedIn recruiter, doctors, lawyers, etc. That's kind of the play as far as like, if you need to spam people, sure. But make sure you have something to say before you just go bang on everybody and their brother's door, giving a message that doesn't convert.
Thank you. I appreciate that. One more thing before you go. So one of the things I also put together was a pitch deck and a business plan. Good. And I've been able to get a lot of traction. Okay. Now, my question to that is, have the perfect pitch deck, business plan, everything sounds great, enough size in the market, but how do I get over well, this is your first deal? How do I get over that? Do I need to fully complete my board of directors? Like scale back and then complete that first to get over this is your first business, so I want to wait to see what you do with this first one before I invest, or what do you?
Yes. You're skipping steps, right? Like, do one thing, finish one thing. Start the next thing, finish the next thing. First, build a deal team. To be frank, like, you have no reason to be talking to investors right now if you don't even have a proper deal team built out, in my opinion. Build your deal team. And then it's not you, it's us. And then we collectively do have experience. And then 80% of that gets removed out of the conversation. And the final 20% that becomes about you simply becomes your ability to communicate like a professional, like somebody who's inevitably going to be successful.
Okay. Thank you.
I could say more, but that's the essence. All right. I've got to go. I've got an internal call here at 11. Look, it's been a pleasure. If you all want more, jasonpaulrogers.com, YouTube, all that stuff, you know where to find me, and all that jazz. I really appreciate you all. We'll do these again here. If you have any questions, info@jasonpaulrogers.com. You can shoot email there. I'll reply, or my team.
Thanks, Jason. Thank you again, Jason. Have a great one.
Yeah, cheers, y'all. Thank you all for being here. Thanks for hanging out. I'll see you guys. Have a good night.